A private equity fund has already called capital, paid expenses, and made investments. 6 months later, a new LP joins and pays $5.2 million. Is all of that capital? Does the fund record profit? Does NAV increase? And should the earlier LPs receive anything? This is where subsequent close accounting becomes tricky. At the first close, investors committed $80 million and funded $20 million. So, 25% of commitments had been called. Now, a new LP joins with a $20 million commitment. To place that investor alongside the earlier LPs, the fund applies the same 25% call rate. That creates a $5 million capital true-up. The LPA also requires 8% annual equalization interest for 6 months. 5 million multiplied by 8% for half a year gives $200,000. So the new LP pays 5.2 million in total. But those two amounts are not the same. 5 million is capital true-up. 200,000 is equalization compensation, and they may follow different accounting treatments. If the 5 million stays in the fund, the entry may be debit bank 5 million. Credit the new LP capital account 5 million. Cash increases and the new investor's capital account increases. Fund NAV also rises by 5 million, but P&L does not increase. That is the first interview trap. NAV can rise because new capital entered the fund, even when the fund earned no profit. Now suppose the 5 million is passed back to the earlier LPs. The receipt may create a payable or a capital reallocation, depending on the LPA and the fund's accounting policy. When the cash is paid, the entry may be debit distribution payable or the relevant partner capital account. Credit bank, cash enters and then leaves. Total fund NAV may finish broadly unchanged, but partner capital balances, funded commitments, and ownership percentages change. So a subsequent close is not simply a cash receipt. It is an economic true-up between investors. Now consider the 200,000 equalization amount. There is no universal journal entry. It may be passed to the earlier investors. It may be allocated as income to existing LPs and charged to the incoming LP. Or it may be handled outside partnership capital. Before posting anything, ask 3 questions. Who paid it? Who is economically entitled to it? And how does the LPA classify it? Now look at the records that must move. The bank, general ledger, partner capital accounts, commitment schedule, equalization calculation, and LP statements must agree. Funded and unfunded commitments must be recalculated. Also check whether the new commitment changes the management fee basis. For a junior fund accountant, the focus is execution. Confirm the closing date and commitment. Re-perform the true-up. Trace the cash. Post the entries. Then reconcile every connected record. For a senior reviewer, the focus is judgment. Does the calculation follow the LPA? Were the correct call percentage and interest period used? Was equalization treated consistently? Did ownership, allocations, or management fees change? And can the investor statement explain every movement? Here is the interview answer. A subsequent close happens when a new investor joins or an existing investor increases its commitment after the initial close. The incoming investor may fund its share of capital already called and may also pay equalization interest. The capital true-up changes cash, partner capital, funded commitments, and ownership. It does not automatically create profit. Equalization may have a different treatment, so the LPA and accounting policy must be checked. Remember the traps. Commitment is not cash. Capital contribution is not income. An increase in NAV is not always profit. Equalization interest is not automatically investor capital. And cash paid to earlier LPs is not automatically an investment distribution. At a subsequent close, do not begin with a memorized journal entry. Begin with the economics. What did the incoming LP pay? Who should receive it? And where does the LPA say it belongs? Search the fund desk on YouTube for complete private equity accounting examples.